Very good afternoon. Look at the market. Firmly above the 2200 mark is what Nifty is. Pull up Bank Nifty, pull up the small cap and the mid cap end of the market. You would see that clearly there's absence of that nervousness which you saw a few days back, and market is coming back very sharply, especially broader markets which are high beta in nature, which really got hit because of this nervousness that continuity on political side would not be there or missing, or could Mr. Modi come back with weaker numbers. All of that led to some amount of shakeout, especially in the broader markets. Pull up a bunch of Adani Group stocks, which are also kind of an indicator that perhaps now risky bets are back in the market. 3 to 5% surge coming in most Adani Group stock, even defense stocks. Pull up Cochin Shipyard, shipbuilding stocks, Swan Energy. You would see all the defense plays are again 5-10% gaining in trade. So this is a clear example of risk on is back in the market. So we thought of getting you a chat with not a very run-of-the-mill fund manager, money manager, but somebody who likes to comment on the market, analyze and run his own money as a hybrid strategy of macros, political setup, then of course taking bets. I'm talking about Harsh Madhusudan Gupta, who's joining me now in the studios. He's an investor and in the process of setting up his own fund, but otherwise too, he's a public interest director at NSE, GIFT City. So very thick in the things as far as the markets go. But today, we're going to scratch your head while you wear your investor's hat.
Yes.
So last 1 week or so, the narrative on the street, which was making a lot of people nervous, Harsh, was that 270 to 280 at max, and low voter turnout was being seen as an indicator that probably the momentum is missing, the wave is missing. That seemed to be getting reversed now. What is your thought on market's way of analyzing voting patterns?
See, I think, George Soros mentioned about reflexivity.
Okay.
So there are reasons which then lead to some numbers in the markets, which lead to narratives which are ex post facto rationalizations. So what happened was the external backdrop in terms of FII money has not been very positive of late, because the Fed higher for longer, for a bit longer, has turned out to be true. Now what happened along with that, DII money was acting as a counterweight, but once some profit booking happened, then suddenly this narrative kind of took on a life of its own. And I think it was just a matter of forming a bottom, which we kind of have seemed to have formed in the last 2-3 days, where a trailing Nifty 50 PE ratio of 21 seems to be the bottom for the market. In terms of voting turnouts, yes, it is around 2-3 percentage points lower than 2019 as we speak, but I mean that could go against the opposition as well. So it is difficult to extrapolate just from the voting percentage to the election results. I mean, even if the opinion polls which were there before the election started turn out to be slightly on the optimistic side, it would seem within the realm of possibility that Mr. Modi's BJP gets a simple majority. Now, let us say it is 275 instead of 315, or let us say it's 280 instead of 320. What really changes, right? So I don't think it was so much a political risk as it was the market DII removing its hands while FI was already removing it, and then an ex post facto rationalization on the election chances led to a bit more panic.
So let's talk about a range of outcomes if they come back with strong majority.
Yes.
How would market read that? If they come back with relatively lower the majority, but the captain remains the same, how would market read it? And also its impact on the reform trajectory, because the street loves Mr. Modi and the entire cabinet, I would say, because of the outstanding work done in many areas. So street actually looks at it dispassionately on the reform trajectory and momentum. So what are the possibilities?
See, I think what really matters is a Lok Sabha majority and a Rajya Sabha majority, right? The BJP obviously was not close to Rajya Sabha majority. It has been slowly building up close to that in terms of the NDA or NDA plus, because that obviously depends on state election results as well. So long as they get close to a Rajya Sabha majority and they maintain a Lok Sabha majority, I don't think the reform process or momentum changes much. What the street wants to know, if there is political stability and continuity on the policy side, yes or no. Right. So beyond the first 3-4 days where there might be some sentimental reaction to 300 versus 280 or 320 versus 280, I don't think it will matter beyond the first week at all, so long as it's a simple majority with, as you said, the same captain in the ship.
Let's get some of your graphics also going, some of the text format which we have shared earlier. What is the setup looking? Let's talk about, and when we are making this question, how the setup looking, we cannot exclude the global setup too. You were saying about how the narrative at the start of the year was that
Yes.
rate cut will start mid-year, but that doesn't seem to be the case. Perhaps it got pushed down. What about dollar index? What about impact of the way dollar index or yields go on flows? Because FII flows, now the narrative is that they are going to China, but fact of the matter that they have been missing for a long time.
So I think what has happened is many of us, including myself, were a bit early on the call of the Fed cutting rates and therefore the dollar index falling. I had come to your show last year and mentioned by the end of this last fiscal year, we seem to be delayed on that by a few months, primarily because of the US fiscal impulse and therefore the growth impulse. The plus side of that is the recession risk in the US seems to have been significantly reduced.
Okay.
Now the US, the Fed is simply looking for a reason in terms of data to cut. It has clearly said it will never raise it. The QT has been halved as we speak. Yeah. And what has happened is ex-shelter inflation, US CPI or PCE is already running around 2% for the last few months, almost quarters. The shelter is a lagged number because the biggest part of the US CPI is a rent which nobody pays. It's called owner equivalent rent between a quarter and the third of the index. That is measured in real time by something called NTR, New Tenant Rent by BLS, Bureau of Labor Statistics. That just turned around zero on a year-on-year basis in the first quarter of the calendar year. Now, actual reported rent in CPI trails that by around 10 to 12 months. Right now, the real-time rent is probably negative in this second quarter. So now it's just a matter of few months. And soon as that starts showing a bit in the data, the Fed will, FOMC in the US will start cutting rates. And then the dollar index, which is around 105 right now, goes back towards 100 and below later. So I think it's just a matter of the final push and kind of panic just before that as well.
And then the FII flows will
towards emerging exactly markets. Because as you have noticed, like FII holdings in NSE 500 is at an 11-year low in India. Yeah. And the DII has increased and they are almost converged right now.
Actually, they are becoming more, I mean, they're tipping over and becoming the larger holders.
Yes, around, at end of March, it was around 16% DII and 17% FII. By now, it might have been equal for all we know.
It's a very important point. I mean, for longest years, for 30, 40 years, the largest holders of quality Indian companies actually after promoters have been FIIs.
Yes.
Now at least our companies are coming back in our shareholding.
Exactly. So what that has happened is the domestic institutional put, so to speak, has been there in the market. So the FIIs have been unable to topple the Indian market. So what will happen is as soon as that FII headwind becomes a tailwind, that is where the real equity party in India, so to speak, begins.
So you expect that to happen?
Yeah, I think as we just discussed, it's just a matter of few months at most because it is directly a function of the FOMC's rates, the federal funds rate.
Let's shift focus and talk about where exactly that flows will go.
Yes.
They'll clearly go to companies which have better quality visibility on earnings front. How have you observed the earnings so far? And do you get confidence in your own model portfolio, which you must have made and tracked because you're in the process of setting up your own fund, that there's 14 to 18% or 20% earnings visibility from here on next 1 or 2 years?
Yes. So, for example, the flows are more likely to come in larger caps from the FIIs. I mean, it's simply liquidity constraints. See, in FY24, nominal GDP growth in India was actually in high single digits, 9.5%. We'll get the exact numbers because the deflator or the GDP inflation, so to speak, was 1 or 2%. WPI was negative, CPI was on the higher side. So, given that, revenue have actually held well. We can see that through real-time proxies like GST collections. And corporate income taxes are a proxy of the profitability of the corporate sector. So, given that actually FY24 was very remarkable, I think FY25 also will continue to be in higher teens. Because see, the fact is the Indian economy continues to formalize. Operating leverage will kick in because capacity utilization, although it's not perfectly measured by RBI, is likely to go up. And then on top of that, financial leverage, let's not forget, because the debt that India Inc. is holding is also at a cyclical low. So all the new money coming in can, either that's going into equity share prices going up, or they can lever up or gear up because their debt is so low.
Okay. Harsh, before I let you go, I know you cannot talk stocks. You're holding, an office on Nifty Gift City till you are setting up your fund. At least give us the direction on which are the areas which you are most constructive on right now, some themes to watch out for, which are durable in nature.
Yeah, from a durable point of view and not just a short-term tactical point of view, I really like all non-lending financials. So asset management companies, especially wealth management companies, in terms of anything that is the market infrastructure around this whole financialization that's happening. On the same note, I like any kind of premium and discretionary consumption, anything related to entertainment where there is less risk of technology obsolescence, like, say theme parks or cricket proxies also. We can, anything that is monetizing the average Indian's increasing leisure time.
Very interesting.
I think that is a 10-15 year play, and many of these stories are actually available at relatively reasonable prices, relatively undiscovered. So more in the largest mid-cap segment from a personal portfolio point of view. But I think the biggest theme remains financialization. However, this cycle of financialization will not necessarily be led by banks, by lenders. Of course, banks and some NBFCs will do well, but the entire market infrastructure around exchanges and equities and wealth management, and I think that really, and AMCs also, for example, last 1.5 years, we saw a massive rally in HDFC AMC. So I think those are still extremely underpenetrated categories in India.
They are the Blackstones, the future Blackstones and BlackRock, which are in making in India, right?
Yes, so let's hope that some of them are already listed. I know there are some in the fintech sector in Bangalore which are not currently listed. But some of them, many of these assets will go 100x from here.
Excellent.
So what happens is we look at a 40p or 35p and we look at 15p. Of course, that is optically more expensive. But you have to look at the visibility of the growth curve and the predictability thereof. So if the predictability is high, if there is a relative moat, then those things can be bought from a 5-7 year point of view. Otherwise, cyclicals you can buy, which are always capacity and demand supply cycles. They may not be 5-10 year buys. For example, hotels are a classic example where doing very well right now, but as supply kicks in 3-4 years, we might suddenly see the operating
overshooting.
Supply overshooting. Whereas, for example, theme parks will be only one in one city, right? Because of the natural kind of local monopoly of there. Similarly, I think there are plays in wine and in some parts of alcohol consumption, which I think can be relatively safe from a market competition point of view. So I think these, and also I would say steel and cement, especially cement, which is a very good proxy to the real estate cycle that India is in the very early stages of an upcycle. Because cement, one must remember, cannot be imported. It is manufacturing that is necessarily localized. In fact, even from South India to North India, vice versa, it may not be economical to transport to that extent, given the price to volume ratio of cement. So those kind of items where there is less market competition and more localization, more premiumization, and where you can play the beta sectors like real estate, discretionary consumption, financialization, I think there are many very good names with reasonable valuations.
Excellent, Harsh. Thanks so much for dropping by today.
Thank you, Ajay.
That was Harsh Madhusudan Gupta talking about how markets are reading or how the markets are positioning, and now, of course, the adjustment happening as far as ahead of the key election event, and, of course, his thoughts on where you should park your money if you are a long-term investor.
If you like this video, then like, share and subscribe to ET Now.